We tend to think of money as a static object, but currency is actually a volatile force. Without management, the money in your pocket constantly fluctuates, and in extreme cases, it rapidly loses value. This line tracks the two primary threats to an unmanaged economy. Crossing the upper threshold leads to hyperinflation, where prices rise so fast that spending power is destroyed. Dropping through the lower threshold triggers a deflationary spiral, where prices fall, production stops, and unemployment rises. Before modern controls, these unchecked swings were common. When people lost faith in the value of their currency, they would rush to withdraw their savings all at once, leading to bank runs and complete systemic collapses. The central bank was established to solve this. It functions as an independent architect, tasked with taming this volatility through constant adjustments to the economy. You won't find individual bank accounts or mortgages here. Central banks are not commercial institutions for the public. They are the regulatory hubs that stabilize the total supply and cost of a nation's currency. This raises a question. If money is so vital to a country, why doesn't the government just manage the supply directly? The issue is the political incentive. Elected officials are often motivated by short-term goals. Having direct control over money creates a temptation to lower interest rates or print cash to create a temporary economic boom right before an election. While these booms look good in the short term, they dilute the currency. Over time, this political interference leads to runaway inflation and long-term economic instability. To protect the currency, the central bank must be institutionally separated from the government. This independence allows them to prioritize necessary, long-term stability, even if it means making unpopular decisions that slow the economy down. The central bank achieves price stability by using specific policy tools to regulate how much money is moving through the system. Their primary tool is the base interest rate. This single dial dictates the cost of borrowing for the entire banking sector. When they dial up the rate, it becomes more expensive for commercial banks to get money. Those banks raise consumer rates, and the flow of capital slows down. If the economy is sluggish, they turn the dial down. Borrowing becomes cheap, pathways widen, and the system is flooded with capital to encourage spending and investment. Their second tool is open market operations. This adjusts the amount of cash in the system by buying or selling government securities. To expand the money supply, the central bank buys government bonds, depositing newly created money into the seller's account. To shrink the supply, they do the opposite. They sell bonds back to the market, removing that cash from circulation. By adjusting these two levers, the cost of money and the total supply, central banks can effectively throttle the pace of a nation's economic output. They also use reserve requirements. This rule forces commercial banks to keep a specific percentage of their deposits in cash at all times, preventing overlending and risking insolvency. While these tools are used worldwide, the specific goals change depending on the institution and country. In the United States, the Federal Reserve operates under a strict dual mandate. They are legally required to achieve two things at once: maintain stable prices and maximize the number of people who have jobs. The European Central Bank has a different focus. Its primary objective is maintaining internal price stability across the Eurozone, rather than directly targeting employment levels. Other major institutions, like the Bank of England and the Bank of Japan, perform similar roles, managing interest rates to maintain monetary stability. Despite these different mandates, every major central bank is built to serve the same purpose: preventing systemic failures that once paralyzed the world economy. The nightmare scenario for any economy is a bank run. If a bank runs out of cash to meet withdrawals, it can trigger a panic that spreads to other banks. Credit freezes, businesses can't get loans, and the economy risks a total collapse. In these moments, the central bank acts as the lender of last resort. Because they have the power to create money, they can step in and provide failing banks with the liquidity they need to stop a panic from spreading. In a globalized economy, these crises rarely stay within one country's borders. Because major banks lend to one another internationally, a failure in one region can trigger a chain reaction that threatens the stability of other nations. To manage this risk, central banks now coordinate their actions through international groups like the Financial Stability Board and the G20. They work together to monitor global vulnerabilities and plan joint responses to cross-border financial contagion. These emergency bailouts are rare. The vast majority of a central bank's work happens quietly, through the daily management of the money supply. Most of us will never step foot inside a central bank, but their mechanical adjustments to interest rates and cash reserves dictate the economic baseline for every loan, business decision, and paycheck in the modern world.